How do private equity firms exit their investments, and how does that impact me? This is a great question. I mean, private equity firms buy businesses, hold them for 2, 3, 4, 5, 6, 7 years, depending upon market conditions and how they're growing the business. Then ultimately, in order to make money, they need to exit their investments. They've got to sell that thing, right? So some years after the acquisition, back during the first part of COVID, when the equity markets were on a tear, in 2021, 22, we saw, primarily in 21, we saw a tremendous amount of exits, and those exits took place at an expedited rate. So the hold period for private equity portfolio companies narrowed, right? So if they would typically hold for 5 years, we saw a lot of holding periods for 2 years because asset prices went to the moon and people exited. But I would say probably a good rule of thumb is 5 years for you to kind of think about. And typically what they're doing is they're either taking the business public, and for most of you that won't be the case, but they're selling it to another private equity firm, or they're selling it to a strategic. So depending upon your line of business, if there's a large publicly traded strategic acquirer in your industry, they might help you grow it and then turn around and sell it to that strategic, right? You might have a big, in your line of business, Home Depot or Lowe's might be the big elephant in the industry, and they might be the type of company that buys it, maybe Apple or Microsoft if you're on the tech side. Will I get a second payment after the private equity firm exits? Yeah, I mean, look, your second payment, or the so-called second bite of the apple, will be due to you in a successful exit, provided you rolled equity. Now, I would say I don't know what the percentage is, but there are a lot of deals that happen with private equity where owners don't roll equity. I mean, I would say the extreme majority of the portfolio add-on acquisitions, so let's say that you've got a private equity company that owns a big portfolio company. Let's call it, I don't know, a big plumbing business, for example. And that plumbing company goes out and makes a bunch of smaller acquisitions. Now, the owner of the portfolio company, the platform, likely rolled equity, right? He likely is a partner with the private equity firm in that business. The add-on acquisitions, some may have rolled equity, some may not have. I would be willing to bet that the majority of them do not roll equity. They were just 100% change of control. And if that was you, there's no second bite of the apple coming for you. But if you rolled equity, if you're a partner with a private equity firm, when they exit, you too shall exit. What happens if a PE firm sells my business to another investor? That's certainly their prerogative. If they're a majority, again, I'm talking about a controlling stake, that's their prerogative. They can do that. And if they do that, you would likely just get paid out at that point in time, depending upon what the agreement says. You'll likely have a shareholder agreement or an equity participation agreement. You might be agreeing upfront to roll equity should they sell to another investor. Something you got to look at. Your agreement might say you get paid out in full should they turn around and sell all or any portion of the business. So pretty much anything in life can be contracted to, and that's why it's really important to pay attention to these documents. What if I wanted to exit earlier than expected? Well, again, this is one of those other contract questions. More times than not, you're kind of shit out of luck. You're waiting until they exit. Now, there are opportunities for you to put equity to them, which effectively means you could sell that back to them at a predetermined price. I've seen that happen. Again, it depends upon how you contract for this, which is why it's very important for you to have a sophisticated banking team and a sophisticated legal team to guide you and direct you on this. How can I ensure I get the best possible deal when exiting to private equity? I would tell you that if you're contemplating selling a majority stake in your business, you would run a formal sell-side process, bar none. That's what you would do. If you were selling a minority stake, right? If you were selling a small portion of your business, you would probably skip that formal process and do it more kind of one-on-one. But yeah, I mean, the best way that you could do it is run a competitive process. Don't be the bonehead that answers the one email from the private equity firm and says, yeah, I'd like to sell my business. I'd like to partner with private equity and then do a deal on their terms. No, you take control of the process and you run it yourself. And if you have any questions on that, I go into far more detail on our sell-side masterclasses. We've done 2 of them thus far. And in the description below, we'll put a link to that playlist so you can get to those. I would watch those. That'll tell you exactly how you can sell your business on the absolute best terms. Thank you for joining me today as I discuss my clients' most common questions regarding private equity. If you've got any questions, feel free to reach out to me directly on the contact form in the description below or join me on LinkedIn. My name is Giannamore. Thank you for joining me today, and I'll see you on the next one.